Hello, this is Steve Coker, president of Cedarstone Advisors, and this is the August edition of Cedarstone Economic Insights. For this month's Economic Insights, we would like to focus once again on the stock market. As we've discussed in the past, the news and to some extent the stock market has become hyper-focused on the first Federal Reserve rate hike. And as we've seen over the past year, the Federal Reserve's mention of a rate hike does cause volatility. However, while stocks have briefly stuttered at the Fed's mention of tightening, stock market investors have quickly moved right back into buying mode on signs of growing momentum in the economic data. We believe that these fundamentals reflect a gradually improving economy that is supportive of current stock prices despite the impending Fed funds rate increase. However, we also believe that much of the good news is fully priced into stocks, leading to a boring, somewhat directionalist market that will only grind higher on the back of good fundamental data. Now, in addition, this week, the news has focused on China's devaluation of the yuan, which sent shudders through the global stock market and added to the 8% decline in emerging market stocks over the past month. Yet, once again, the market has quickly stabilized based on strong fundamentals in the US. So for this month's Cedarstone Economic Insights, I think it would be worthwhile to review some of the fundamental data coming out of the US to show why the market is showing such strength. Briefly, we'll take a look at disposable personal income, the non-manufacturing purchasing managers index, job openings, car sales and housing starts, and the broader leading economic indicators. Let's dive in. Remember, Americans are still the growth engine of the global economy. Personal income and spending in the US have been in recovery for over 5 years, following the sharp recession-related correction in 2008. Because personal spending accounts for 68% of GDP, the rate of change in personal spending is key to the rate of change in GDP. Said more simply, personal income drives spending. Spending drives corporate earnings. And as you can see from this chart, disposable personal income has been trending steadily higher. Also on this chart, you can see the personal savings rate. Note that during the recession, personal savings surged. Now, since the recession ends, savings have gradually trended back down as consumers have restored confidence and begun spending once again. In summary, disposable income has grown at a healthy pace, Americans are saving more, and this is good for the long term. Next, let's take a look at the non-manufacturing purchasing managers index. Now, this index captures the vast majority of the US economy and hit a record high of 60.3 in July. A reading greater than 50 indicates expansion. Next, let's take a look at housing starts and car sales. Why car sales and housing? Because combined, they represent about 13% of the US economy. Once again, we can see that car sales and housing both show steady improvement from recession lows, but still show potential growth when compared to pre-recession levels. Next, let's take a look at job openings, which showed a record high as of the most recent release in May. And finally, let's take a look at the broader index of leading economic indicators, which is a composite of forward-looking economic data. The big picture here, as captured by the latest release, dated June 18, 2015, is a pickup in the rate of growth ahead. Remember that the leading economic indicators have historically rolled over very definitively prior to a recession. There's no suggestion of that kind of pattern at present. So in summary, the US economy is still growing, but issues remain, particularly in the international markets, pointing to slow action by the Fed, which is fundamentally good for stocks. I hope that gives you some additional insight beyond what the news cycle is saying. If you have any questions, feel free to give us a call. Thanks so much.